All right, we are just about 15 minutes away from the start of a new week of trading, and while the markets have been resilient, we've talked about that. Could there be more volatility, especially with ongoing uncertainty around trade? Expected to be a big week with the Trump administration looking to get some deals done ahead of a July 9th deadline. Michael Green is a portfolio manager and chief strategist at Simplify Asset Management and joins us now. Michael, great to have you with us. What's on your watch list? Like when you look at all the headlines coming out of Washington, what matters the most to you as an investor?
Well, I think as an investor, it becomes somewhat different from a citizen. From an investor standpoint, many of the steps that are being taken, importantly, extending the Trump tax cuts from 2017, are kind of paramount on concerns. If those had been reversed, this would have been one of the largest tax increases in history. So by maintaining the status quo, from an investor standpoint, we've clearly succeeded in one of the key objectives with this tax policy. I think the thing that I'm finding a little bit confusing is the degree to which this is being viewed as stimulus. Yes, the one big beautiful bill on its own significantly increases the quantity of debt, but in combination with other actions that are also coming from this administration, in particular tariffs, the resumption of student loan payments, et cetera, I really struggle to see the degree of stimulus that at least I'm seeing echoed in headline reporting on this. Overall, the Trump administration package seems to me to be moderately contractionary, actually, for 2026 when I consider the quantity of government spending that is likely to come out. And that's before we consider the potential for interest rates to be reduced further than the market's currently pricing if Trump follows through on his threats to replace Jerome Powell as Fed chair.
That's helpful context. The other thing I find very interesting, and I don't know if it's because we just have all these like robust ecosystems where people are talking about sort of separate things, but you can bring them all together on your phone. There's a huge chorus of people who are worried about the fiscal picture for the United States, and there's also a very strong investment story that sort of bleeds into that. We were talking about gold before the break. You got Bitcoin. And it doesn't feel to me like, at least in terms of sort of buzziness by people who are in and around the markets, we've ever been at a point in history where we've had that before, that you can talk about what's going to happen this year, as you were just alluding to, and then what could happen in 10 years' time. As a veteran investor, what's your take on that as well? Because, hey, we've had like signature bills that different governments have put forward for years, but the market has, generally speaking, always struggled to sort of think about where we'll be in 10 years. It usually is thinking in quarters, or at the very much 12-month periods. What do you think about how this big, beautiful bill factors into that dialogue?
Well, I think that it establishes priorities, right, or reestablishes priorities that were very clearly articulated in the first Trump administration. The idea being fairly straightforward: if we cut interest rates on the highest earners, tax rates on the highest earners, that they will return that through productivity enhancement into the economy. I'll be honest with you. I mean, I've been doing this now for 30 plus years. I've seen multiple cycles on this. I think the defining character this time around is the general cynicism or even nihilism around it, which is simply the argument that, well, there will always be more money spent. We can't have another recession, et cetera. That never really rings true, right? If it were true, we would have solved that problem a long time ago. The simple reality is that the economy has slowed down significantly. The administration's policy on immigration is lowering the labor force growth rates. We're starting to see tightness in the lower end labor force. Those with less than a high school degree are finding the market to be relatively robust. If you're competing in many of the physical services industries, this is actually a pretty good economy. But for those with college graduate degrees, et cetera, it feels like gaslighting, right? We're seeing unemployment rising significantly in things like computer services. And as I sent in some of my notes, one of the biggest things that we're actually seeing is a general deterioration of the services market. It's making up less of consumer spending than we've seen in prior cycles. A lot of that, I think, is a function of what I would refer to as the productization of services. We're moving from people working at a call center to an AI call center. We're slowly moving from people driving cars, which is by far the most common job, to self-driving cars. this sort of transition has really only happened a few times in history where there's been a major reordering of the labor force on the basis of what people are doing. And it feels like that's contributing to, I think, the general sense of uncertainty. Is my job valuable? Will I still be employed in 5 to 10 years? Seems to be much more the sentiment that's in the labor market as compared to the markets overall.
Yeah, listen, I love it, Michael. I appreciate you going deep because we have to. Technology is coming at us very quickly, and it's going to have economic impacts. We'll see ultimately what those look like. Before I let you go, something that has long-term ramifications, but I guess it's more of a short-term question. You mentioned lower tax rates, but I think the U.S. president has also talked about wanting lower interest rates, and he's been pretty aggressively telling that to the U.S. Fed Chair Jerome Powell, who's probably at the same time, Powell that is, looking at this spending and trying to figure out what that's going to mean for inflation in the U.S. So if you had to guesstimate what happens with interest rates in the U.S. for the rest of the year and how the market interprets that, what would you say?
Well, I think at the end of the day, the Fed is going to respond to its dual mandate of inflation and unemployment. We are starting to see the unemployment market weaken. We are seeing jobless claims begin to tick up. While I disagree with how the Fed is interpreting the data, they are slowly coming forward and assessing that tariffs do not seem to have had the inflationary impact that they were concerned about, or that at least has not flowed through yet. It's going to get more difficult in the back half of the year. I just want to emphasize that the residual seasonality that comes from the pandemic means that we will likely see inflation begin to pick up in the back half of the year. That's tied to the way we do seasonal adjustments here in the United States. My hunch is that we got at least a 50 basis point cut from the Fed tied to the weakening of the labor market. But I think it'll be a new Fed chair before we're looking at significant cuts.